Thanks everyone thank you for being here. The pleasure to have with us as invitees of this webinar Pablo Morales and Ramon Diaz from Anderson. Thank you, Pablo. Thank you, Ramon, for making the time. I know you guys are super busy, so it's really a pleasure and appreciate all the time and your effort to be here. This is our first webinar in English, by the way, and I think this webinar will help a lot of our clients, a lot of our potential clients to establish in Mexico. Uh, so, Pablo, you and me worked together in several projects before. Ramon, nice to meet you. Thank you for being here. A little bit about background of Pablo and Ramon. Pablo is an specialist in tax and corporate law in-house lawyer at ArcelorMittal, Mexico, and currently partner at Anderson Professional Services. He published articles in special journals such as Puntos Finos and IDC. Both of these magazines are really very technical for the accountants and tax attorneys in Mexico. So teaching experience at the Faculty of Law of Universidad Panamericana in income tax law, VAT seminar, practical tax cases. He is member of the Tax Technical Commission of the Mexican Institute of Public Accountants. Thank you, Pablo. Thanks a lot for being here. I know you're going to be very helpful for a lot of questions that our clients have. On the other side is Ramon Diaz Alonso. He's a legal manager at Anderson Professional Services. He earned his law degree from the Universidad de las Américas in Puebla. He has a master's degree in international law, foreign trade, and international relations from ISDE, Barcelona, Spain. He also is a specialist in commercial contracts, corporate secretarial services, intellectual property, and regulatory compliance. He has extensive experience in national and international M&A transactions, providing strategic legal support in reorganization and business growth processes. Thank you, Ramon. Thank you for being here. Appreciate all your time also. And this is me, Rodolfo. I'm the one that coordinate this webinar with Moni. Moni is behind the scenes, and she's gonna help us with the presentation. So Ramon and Pablo, as you know, we have a lot of cross-border transactions, a lot of U.S. companies doing business in Mexico, but also European and Asian companies doing business in Mexico. And we as an accountants, sometimes we know that there's some tax compliance in Mexico that the clients needs to be very well informed before they establish a company in Mexico, because doing business in Mexico is really different from like other countries, right? Mexico has their own way to do business, and it's very important that the clients understand how and what is going to be the tax implications before they start the business in Mexico. So you guys are the experts. I'm going to give you the presentation to you, Pablo and Ramon. And again, thank you so much for being here. It's a pleasure to have you. And hopefully we can meet you in person pretty soon. So, Moni, can you go ahead and start? Pablo, Ramon, it's all yours. Thank you.
Thank you, Rodolfo. Thank you, Ramon. It's a pleasure, and thank you for inviting us to share some insights of Mexican legal framework and tax framework for companies that want to establish them in an open business in Mexico. So the presentation will have two parts, will be divided into parts. The first part is the lecture of Ramon, the legal structure, options of establishing a new business in Mexico, and the pros and cons, the risks and the benefits. And the second part that I will be exposing is high-level tax overview of the Mexican framework in that regard, so that our participants can leave the webinar with a broad idea of what happens in Mexico and what are the steps that have to be taken. Of course, always the first recommendation is always to have the proper legal advisory for all the Mexican ecosystem, regulatory, bureaucratic, tax-wise. But well, to give a high level approach of the Mexican environment. So please, Ramon, take the floor and thank you all for being here.
Thank you very much, Pablo and Rodolfo. Nice to meet you too. And good morning to everyone. As Pablo says, during the next few minutes, I like to focus on one of the very first decisions that any foreign investor needs to make before entering the Mexican market. The first decision would be considered through the following question. How do you want to establish your presence here in Mexico? Because depending on your business objectives, the answer may be completely different. Some companies are only exploring the market. Others already know they will operate here for years. Others want to operate directly through their existing US companies. So all of those are perfectly valid business strategies. They simply require different legal structures. So rather than asking what is the best legal entity in Mexico, I encourage you to ask a different question. That is, which legal structure best supports my business plan? That's exactly what we will discuss over the next few minutes. Let's begin by asking ourselves 3 simple business questions. Next, please. Great. Whenever we meet a client planning to expand into Mexico, we do not start by discussing the legal entities. We start by asking 3 questions. The first one is, are you entering Mexico to exploring the market? Or the second, do you want to operate directly through your existing foreign company? And third, if you are planning to establish a long-term operation here in Mexico. So the answer to these questions will usually guide the correct decision. Let's take a closer look of each of them. Let's start with what is probably the most common structure we recommend to foreign investors. Next one, please. For most foreign companies entering to Mexico, this is where the conversation usually starts, a Mexican subsidiary. And there's a very practical reason for that. Most of companies that decide to invest in Mexico are not simply testing the market anymore. They already have a business plan. They intend to hire employees, open bank accounts, and invoice to their customers. And at the end, build a long-term operation. So a Mexican subsidiary provides a separate legal entity through which all those activities can be conducted locally. From a practical standpoint, in our experience, this is the option that most foreign investors here in Mexico choose. Now, once a company decides that a subsidiary is the appropriate structure, the next question becomes, what type of company should we incorporate here in Mexico? Next one, please. Great. Once we have decided that a subsidiary is the right entry strategy, the next question is, what type of company should we incorporate? Because in practice, for foreign investors, the conversation usually comes down to 2 options, the SADCB and the SRL de CAB, ¿no? Que es sociedad anónima de capital variable y sociedad de responsabilidad limitada, ¿no? También con capital variable. If you're familiar with US entities, you can generally think of an SA as being comparable to a corporation and an SRL as being comparable to an LLC. So clients often ask us which one is better, and always our answer is the same. It depends on your business objectives. So the decision should be considered both the corporate and the tax implications. Once the entity has been selected, the next logical question becomes, how do we actually incorporate a company here in Mexico? Next one, please. Great. One of the questions we hear most often is how difficult it is to incorporate a company in Mexico. The good news is that the process is generally straightforward. As you can see, the process follows a clear sequence. The key takeaway is simple. Good planning leads to a smooth implementation. Most delays happens because information or documents are missing. So now not every company entering Mexico is ready to establish a full operating subsidiary. Some business simply want to understand the market before making a larger commitment, and that's where our second alternative comes into play. Next one, please. Thanks. Not every expansion starts with a full-scale investment. Sometimes the first step is simply understanding the market. So that's where a representative office comes in. Think of it as your company's eyes and ear here in Mexico, allowing to explore opportunities before deciding where to establish a long-term operation. So what exactly a representative office can do, and perhaps more importantly from my point of view, what can't it do? The next one, please. Thanks. This slide highlights the key distinctions of a representative office. On the left are activities that are generally consistent with its purpose, like market research, promotional activities, building relationships with customers and suppliers. That, in other words, these are activities that help you to prepare to enter to the Mexican market. So on the right are activities that needs to be avoided at any time. This is because a representative office is not intended to conduct commercial operations or generate revenue in general. So I usually tell clients that there's a very simple way to evaluate any activity. That is, am I preparing to doing business in Mexico, or am I already doing business here in Mexico? So if you are still preparing, a representative office might be the right option. If you are already doing business, it's probably time to consider a different legal structure. But even a representative office requires a legal implementation process. Next one, please. Thanks. Fortunately, establishing a representative office is generally less complex than incorporating a Mexican subsidiary. Most of the legal work focuses on documenting the existence of the foreign company, confirming who will represent in Mexico, and completing the corresponding legal formalities, depending on the circumstances. Also would be required some governmental registrations that are not like very extensive. But the important takeaway, however, is not the documentation itself. The important takeaway is understanding that the legal process generally reflects the limited purpose of the representative office, since this structure is not intended to conduct business here in Mexico. Its implementation is typically more limited than that of a full operating company. And that's exactly how it should be. The legal requirements should be proportionate to the activities the structure is expected to perform. However, there is one issue that deserves special attention, and in my opinion is the most important risk associated with this structure. Next, please. Thanks. The biggest challenge with a representative office usually isn't setting up. It's knowing when it's time to move beyond it. companies often begin with activities that fit perfectly with its purposes, meaning potential customers, attending trade shows, or conducting market research. But as the business grows, those activities thus often evolve into commercial discussions and eventually commercial operations. That's the point where the legal analysis changed completely, because a representative office is designed just to be a temporary stage in your expansion strategy, not a permanent or long-term solution. So once your business is ready to operate here in Mexico, your legal structure should evolve as well. So, and that brings us to our third option. Could you please change? Thanks. Let's look at our third and final entry strategy, that it's a branch. A branch is often considered when a company is ready to do business here in Mexico, but prefers to operate directly to its existing foreign company rather than incorporating a separate Mexican company. Unlike a representative office, a branch is intended to conduct commercial activities. So this could sign contracts, generate revenue, and carry out business operations in general. The key distinction is that it does all of this as a part of the foreign company itself. There is no legal entity separated here in Mexico, and that's the key concept to remember. But what does it actually mean to operate directly to your foreign company? That's where the real legal distinction lies. Next, please. Great. I'd like to explain this with a simple example. Imagine your company is headquartered in Texas and decides to operate in Mexico through a branch instead of incorporating a subsidiary. The key point is this: a branch is not a separate legal entity. It is simply the foreign company operating here in Mexico. That matters because the rights, obligation, and potential liabilities generated by the branch here in Mexico remain connected to the foreign parent company. So when clients ask whether a branch is the right option, our answer is always another question. Are you comfortable operating in Mexico without creating a separate legal entity? Because I think that's really the decision you are making. This is because a branch conducts business directly here in Mexico. There are certain legal formalities that must be completed before operation begins. Next, please. Thanks. From an implementation perspective, a branch generally requires more formalities than a representative office. That's because the foreign company itself will be conducting business in Mexico. As a result, the authorities typically require additional corporate documentation and registrations before operations can begin. The specific requirements depend on the circumstances, but the key takeaway is simple: the more direct the foreign company's presence in Mexico, the greater level of governmental oversight. Unfortunately, we proper planning this process is straightforward and manageable. So we have now discussed the three most common alternatives available for foreign companies entering Mexico. The question now becomes: how do we choose between them? Next, please. Great. This comparison brings the key differences together. In practice, the decision comes down to three basic questions. Will you conduct commercial activities, or do you want a separate legal entities? And what is your long-term business plan? Those answers will guide totally to the choice of the structure. And that brings us to the final question. If you were sitting across the table from us today, what would actually recommend. Next, please. Great. If there is one idea to take away from this section is this: start with the business plan. The legal structure comes second. If your goal is to explore the market, a representative of office would be enough. And if you need to operate directly through your foreign company, a branch may be totally appropriate. And if your plan is to hire employees, sign contracts, generate revenue, and build a long-term operation here in Mexico, a subsidiary is usually the most suitable structure. So the key is alignment between the legal vehicle and the way you intend to do business here in Mexico. That's all from my side. Thank you very much.
Thank you, Ramon. There's when you were talking, I was like in my mind a lot of things going on about the tax implications. For example, on a branch, difference from
Yeah,
a
of course.
subsidiary. Also, we have a lot of Americans doing business in Mexico and understanding the difference, as you said, between the SDRL from the SADCB is a big difference because they can treat the foreign company, in this case, the Mexican entity, as a pass-through entity for taxes purposes in the United States. But you have to check the box and do the correct, steps on time. Sometimes if you don't do it
Totally.
on time, it's too late to do that. So that thank you so much for all your explanation. I don't know, Pablo, if you want to say something about all what Ramon said.
Yeah, well, I just want to emphasize that the legal structure that any company, any foreign company should choose for its business in Mexico will depend in the business plan. And for tax purposes and precisely for tax auditing purposes, if the authority in any given time or any given moment audits the company or requests the company any documentation or information, it is important that the legal structure that will have tax implications, as we will see in the next minutes, should respond to a business reason. The first thing that the tax authorities ask to any company, any taxpayer, is what is the business reason for this transaction or this operation or this purchase, and basically for this business model that you are carrying out. And of course, there are well, the main takeaway from this first part of the conversation is that the legal structure should respond to the business plan, and everything has to be supported by a business reason. So I think that's the key takeaway from this. The other parts are like practical issues that may be carried out with the proper legal advisory, but strategically speaking, the legal structure should respond to the business plan that the company has in Mexico. All the further steps, they may go easily if that question is clearly answered and as a clear business reason for any of these structures.
Yeah, and also I just want to add something. It's very common that we receive a lot of emails from foreign people, Pablo, Ramon, that they want to have a tax ID. Oh, I need a tax ID. I'm pretty sure because they are probably selling online or something and they have a big withholding or something like that. I'm not pretty sure, but a lot of Asian guys, we receive emails that, hey, what I need to have an ID, and sometimes explaining them to have an ID and have, operate a business in Mexico It doesn't matter that you don't have an office in Mexico or you don't have an employee over there, right? Sometimes if you are doing business through the online, which is the electronic way to do business right now, which is very common, they just need the tax ID to probably not make the whole withholding, but explaining all these people how to get a tax ID in Mexico is pretty difficult. They don't understand it very well. It's so complicated, right? You need to have an appointment and then you have to go in person, and all about this situation, which is different from, for example, from United States. To get an ID is not so complicated, right? You don't have to have an appointment. You don't have to go in person. So that's sometimes the big difference that we find out as an accountant, that we receive a lot of email from foreign people that they think that having an ID is pretty easy or complying with the Mexican tax rules are really easy. And it's not that way. We know exactly that it's not that way. I just want to add that. Thank you.
Exactly. Yeah. Well, that's why we every company that wants to establish in Mexico has to have the proper advisory for those purposes, tax wise and legal wise.
Exactly.
Okay. Well, if we continue with the presentation, now we're going to talk about the tax implications of a new business that is establishing in Mexico. The next one, please.
Yes, I'm sorry. There is a question in the chat.
Okay. Besides that, what are the biggest legal operational risks when choosing the wrong structure? Do you have any comment on that, Ramon?
Yeah, of course. I think that, for example, if you go through a representative office and you start making operations, I think that all these structures at the end rely on tax matters in the principally, but you will need to be forced to become with another legal structure that might you will be incurring to more cost with all of this movement. So that's why there is no like potential liability on that, but I think you will be incurring in more expenses and cost since advisory or even tax matters, as I said. So I think that's the main point.
Yeah, there is no any sanction of choosing the wrong structure in terms of getting canceled your permission or your authorization to conduct your business, but it is more like a liability in front of other people and before the tax authority. So I believe that those are the key issues in this regard. Okay. If there's no other question in this first part, we can continue to the next slide, please, Monica. And the next one. Well, we have to consider. Well, it depending on the structure that you choose based on your business model. If it's a Mexican subsidiary, it will be an incorporated entity in Mexico that will be a Mexican resident for tax purposes. That has some legal implications. If you're establishing a branch, maybe you're generating a permanent establishment in Mexico and has another tax implications that are very similar to the ones of a Mexican resident. If you're only having a representative office, you may not have a permanent establishment if you are conducting a preparatory or auxiliary activities of your main business. But you have to be very careful in the terms of the activities that you're conducting, so you can avoid the risk of being attributed to as being a permanent establishment that may trigger tax implications before Mexican authorities. So in the first part, I will be talking about the tax framework for Mexican resident entities as a subsidiary or a permanent establishment. And then in the second part, I will be talking about these key differences between having a permanent establishment and the activities that may trigger a permanent establishment, and the activities that may conduct a representative office that do not constitute a permanent establishment, and some key questions that we have to answer in order to avoid the permanent establishment status before the tax authorities. So as a broad basis, a high-level framework, the corporate income tax in Mexico, the Mexican resident corporations, for income tax purposes, they are taxed on a worldwide income. And this is important when we're talking about a subsidiary of a foreign entity, because if the Mexican entity has a revenue or an income that comes from the foreign entity, the foreign related entity, that income should be taxed, or it will be taxed by Mexican authorities. On the other hand, non-residents are taxed on Mexican source income or revenue attributable to that permanent establishment. In this case, if the foreign entity has an income or generates a revenue from the Mexican subsidiary, from interest, royalties, or any other dividends, they will be taxed in Mexico with some rules that we will talk about in the next slides. So that is important to have in mind. And nowadays, corporate tax planning typically focuses on operational margins, transfer pricing compliance, financing structures. And nowadays, in Mexico, in Mexican environment, the best tax planning is a strong compliance planning. Nowadays, the aggressive planning is not a business anymore, because we have many anti-avoidance rules that try to tackle the aggressive tax planning. So from a practical perspective, we think that the best tax planning is having a strong compliance effort, or make a big compliance effort to go with the tax provisions. So specifically speaking of corporate income tax, the standard federal corporate income tax is at 30% rate, which will be calculated or will be applied to a profit calculated based on an adjusted accounting revenue with some statutory deductions. This is the 30% rate is not applicable to the gross revenue. The companies can deduct all the expenses that are necessary for the business, and that will derive in a profit that will be taxed at the 30%. If in any given tax year the company has a net operating loss, that can be offset in the following years against the revenue, the profit that will be generated in the next years. We have a carry forward rule for up to 10 years, with some rules and some provisions that try to limit the commercialization of losses. You cannot transfer it to a third party, not even because of a merger or a spin-off. And there are many rules that tackle or limit the set-off of the offsetting of the losses. And we do not have a carry back provision for the losses. Of course, this is an important part of the tax framework. It's broadly speaking of multinational entities, is that transfer pricing rules require related party transaction to follow the arm's length principle. We in Mexico, the Mexican legislation, we are ruled by the arm's length principle. And something important is that the OECD TP guides are applicable by statute. It is not just a common knowledge that these rules and these guides are applicable. By statute, they are applicable. What activities are more likely to create a permanent establishment? We will see that. We will address that question in the following minutes. The next slide, please. In terms of the value-added tax, because the two main taxes in Mexico for companies are the corporate income tax and the value-added tax. The standard rate is 16% for the commercialization of goods, rendering services, and the lease of any goods in Mexico. To this rate, the 16% rate, companies can offset and deduct the input VAT that they pay to their vendors and suppliers. So the tax burden tends to be diminished in that sense. But something that is very important in terms of multinational entities and groups is that the export sales are zero taxed, zero rated. So you don't pay any VAT on the export of goods. But something that is even better is that as it is 0% rated and not exempt, is that you can recover all the input VAT that is transferred to the company by their supplier. So you can recover that as the refund for the tax authorities, and this is a stream of cash that may be very useful for any company. In the export industry here in Mexico, because of our neighborhood with the US, the manufacture and the maquila activities are very broad extended in Mexico, and we have many incentive programs for exporting manufactured goods and maquila processed goods that allow the companies to operate in a structural VAT refund position. This is, according to these programs, you don't pay the VAT for temporarily importing the goods. You can process them and then export them 0% rated, but all the input VAT that you pay to your vendors can be refunded by the tax authorities. Something very important in exporting and manufacturing and in any other activity in Mexico, if you're conducting business in Mexico, is that for recovering those input VAT balances, you have to comply with some formal requirements as invoicing. Invoicing is very important. So you have your invoices duly issued to your clients and the ones that your vendors issue to yourself. You have to have all the proper documentation and evidence of all the business and the transaction that you're carrying out, and the export evidence for the VAT recovery if we are in that business, in that sector. The very most important part is that you have to demonstrate with the substance of your transactions, of your suppliers, your goods suppliers, and your services providers, that you have to demonstrate the substance in the input goods and services that is required for recovering that VAT. Just to have in mind, the food industry and the pharma industry, this is selling food and selling medicines in Mexico, is zero tax rated, and that allows the companies to recover all the VAT transferred by their vendors. So this is very important in VAT considerations. The next one, please. So when we are talking about a multinational company or a multinational group, something that we have to bear in mind all the time is what are the tax effects in cross-border transactions and cross-border payments. In one hand, if the foreign entity is receiving a revenue, receiving an income from the Mexican entity, probably it will be taxed by the Mexican law, and of course the Mexican or the double taxation treaties that Mexico has in place with many other countries. So What are the withholding obligations of Mexican entities? And we have to bear in mind that if the Mexican entity has to withhold a tax, is because that tax is triggered by the foreign entity. So this is very important to have in mind. Typical payments to foreign entities that may trigger withholding taxes: dividends, interest, royalties, technical services, capital gains, and all of them have their specific rules in Mexican legislation. Dividends are taxed to a 10% rate. Interest, it depends on the lender classification. Royalties, it also depends on the kind of royalty that you're paying. Technical services, there's some discussions about the technical services are taxed in Mexico, or they can be considered as business profits. There are contradictory precedents in Mexican courts, and of course, capital gains. We have the Mexican income tax law, but we also have the broad net of double taxation treaties in place with many other countries that may give the companies and the multinational entities some benefits related to the rates of the withholding or the conditions to consider that a specific revenue is Mexican sourced or has its source in Mexico. For example, the Mexican treaty with the UK or Spain, they exempt the withholding for dividends, but you have to comply with several conditions. You have to comply with the limitation of benefits clause in Mexican legislation. You have to comply or demonstrate that the company that you're paying the dividend for, or the interest or the royalty, is the beneficial owner of that revenue, and it is not only a pass-through entity for a third company in a third country, right? So those aspects have to be very well taken care of in your planning and in your strategic thinking in your business. Next slide, please. On the other hand, what are the tax implications for the Mexican entity that makes the payments to the foreign entity? For the first obligation is to withhold the tax and pay to the Mexican entity. If the Mexican authority, if the Mexican entity does not withhold and pay the tax, it becomes jointly liable. So the tax authorities will ask the Mexican entity to pay that tax that was not withheld to the foreign entity, and they can issue or initiate any audit to enforce that withholding to directly to the Mexican entity. So it is important to assess the risk of not paying or not making the withholding and paying it to the Mexican tax authorities. Something important: payments made to tax havens or low tax jurisdictions are not deductible as a rule. So if you have in your structure, you have an entity in a low tax jurisdiction, we have to be very careful if that payment goes directly to that entity, or if it goes indirectly to the low tax jurisdiction, because if that's so, the payment will be not deductible for Mexican tax purposes. And of course, the withholding will be a 40% rate with no deductions at all, which is like a very heavy tax burden for the foreign entity and the Mexican entity that has to withhold the tax. For example, the deduction of interests are limited by thin cap rules and adjusted profit thresholds. This is newish rule, the adjusted profit threshold that has to be complied by Mexican entities in deducting the interests. So we have to be very careful in this regard. We have a limitation of benefits clause in Mexican legislation that we have to comply with formal obligations and procedural obligations in order to have the benefits of the double taxation treaties. Of course, the deduction and all the transactions that are carried out with related parties are subject to the TP rules in Mexico. And as I mentioned before, the OECD guides are applicable for Mexican legislation. So that is also a very important part to have in mind regarding the transactions between related entities. So once we are established and we start complying with our taxes and filing our returns, the monthly and the yearly returns, and the informative returns, and we are conducting our business, there's always the risk of an audit by the tax authorities. And I want to highlight which are the key issues in an audit, and not but from a preventive perspective, not to react to these issues when the audit is already started. So on the contrary, it is important to have these issues in mind to prepare for an audit, or to try to diminish the risk of an audit, or if the audit is initiated, to have a better chance of having a favorable outcome in the audit. To start, nowadays in Mexican framework, in Mexican tax environment, the most important part is to demonstrate the economic substance and the business reason of any transaction, specifically those that imply a deduction for income tax purposes, or an input VAT for VAT purposes, which are concepts that are transactions that may diminish the tax base for Mexican purposes. So we have to always support the economic substance and the business reason. How do we do that? Specifically, the economic substance, with the proper evidence of the deduction. We have to be able to provide to the tax authorities all the evidence, the material evidence that any service was effectively provided, that any good or commodity was effectively purchased to the supplier, so we can demonstrate that the deduction was real. We have to bear in mind the effective rates that the tax authorities have in mind for each sector of the industry. This is which rate, how much interest, how much tax did you pay according to your total revenue? And the authority has this risk management assessments, and if you pay a higher rate, you're not at risk. If you pay a lower rate, you're considered a risk. This doesn't mean that if you're paying a lower rate, you're in default, or you're not complying with your obligations. There may be many reasons that you're paying a lower tax, and many a year that you're making many deductions, many investments, maybe 100 reasons to have a lower tax rate. So this does, if you're there and if you're deemed as a risk by the tax authorities, does not mean that you're not complying with your tax obligation, that you're able to demonstrate to the tax authorities that you're complying. We in Mexico have an electronic system of invoicing and tax returns. All that information is electronic and is provided to the tax authorities online and in real time, so they can match the invoices and your revenue that it is declared in your return. I'm sorry. So if they find any mismatch in those two documents and in many others that they have. You have to upload your books to the tax authorities on a monthly basis. If they find that there's any mismatch, it can trigger not a formal audit, but any information request by the tax authority. So we have to be very careful with the compliance and having all those documents in place and in the same page, so that we don't trigger any yellow flag for the tax authorities. And regarding the application of tax treaty benefits, the beneficial owner for the treaty benefits. We have a recent precedent issued by the tax court, not the Supreme Court in Mexico, is the administrative court that has some standards for applying or considering who is the beneficial owner of a company, of a revenue. So we have to be very careful in documenting who is the beneficiary of those payments. So these are the key issues. There are many more. This is just a high level explanation. But I think if we have to take one idea from this talk is those issues regarding an audit. Next slide, please. So we mentioned that if you establish a branch, you are probably are going to be deemed as a permanent establishment in Mexico, because you will be conducting business activities that will be generating revenue in Mexico. So for Mexican legislation, any place of business where business activities or independent services are carried out partially or totally is considered a permanent establishment. And some they are considered as a permanent establishment branches, agencies, offices, facilities, mines. The mining industry, just for having your mine in Mexican territory, it is considered a permanent establishment, or any place of exploration, extraction, or exploitation of natural resources. For example, if you lease a rig, a drilling platform to to Pemex, for example, that is a permanent establishment for the foreign entity. So, addressing the question that was made before in the chat, any business activity or independent service that is carried out in one of those places will be deemed as a permanent establishment and will tax in Mexico. Mexican authorities are entitled to request the payment of the income tax to this to the entity or the foreign company that has a permanent establishment, because it is deemed that they are generating revenue in Mexico, conducting business in Mexico. For example, once again, the double taxation treaties come into the conversation, because there are some different criteria to deem to have a permanent establishment in Mexico, according to the treaty and according to the Mexican domestic legislation. So we have to have in mind both laws and both rules for these purposes. And this is related specifically with branches that Ramon mentioned before. Next slide, please. And if you're having a representative office, and if you're conducting only auxiliary or preparatory activities, you should not be deemed to have a permanent establishment. But we have to be very careful in this regard. According to Mexican law, there is no PE if you conduct preparatory or auxiliary activities. And broadly speaking, there is no PE if the following activities are carried out. This is like facilities to store or display good or merchandise, keeping stocks or goods or merchandise for storage, display, or processing, purchasing goods for the foreign resident, advertising, supply of information, research, preparation of loans, not granting the loans, just the preparation for the loans. Bonded warehousing. This is like a foreign trade or an importation regime for Mexican purposes. So if you see all these activities, they are not generating a revenue directly. So if you're conducting these activities, no PE will be deemed, and no tax will have to be paid to Mexican entities. But we have a clause in Mexican legislation. If all these activities are part of a cohesive business operation, this is the company try to fragment all these activities. They will be a permanent establishment. So in this regard, when we're having a representative office, we have to be very careful to that the substance or the activities that will be conducted by this office do not or are one of those that are outlined by the Mexican law. And just to be very careful that we don't seem to be having a comprehensive or a cohesive business to be deemed as a permanent establishment. So that is I think very very important to have in mind regarding the multinational entities. Next slide, please. Of course, we have also state level taxes, subnational taxes, and some local incentives. Additionally to the federal taxation, Mexican states can tax the companies, and it is important to have those taxes in mind. Although the principal tax burden for companies are federal taxes, also state taxes can have to be, we have to deal with them, because if we don't plan according to them, some liabilities may be triggered. What are the common state taxes? Payroll tax. If you pay wages to your employees, that triggers the payroll tax. Typically is between the 2% and 4%, depending on the state. Property tax, local administrative fees, local infrastructure contributions, depending on the industrial zones, and, for example, in states that are very tourist places, like Quintana Roo or Baja California Sur, there is a tourist tax, or in many others, the selling alcoholic beverages triggers also some taxes. So we have to have in mind those taxes. But also in many states, we have incentives, and the idea of those incentives is to attract foreign investment. For example, in Nuevo León, we have some payroll tax deductions and infrastructure support for strategic manufacturing projects. For example, a big automotive company is established in Nuevo León, and they take these incentives, and it was a key part of the decision of establishing in that Mexican state. For example, in Baja California, Tijuana, Ensenada, incentive tied to export manufacturing clusters and border region economic activity. In Guanajuato, in the middle region of Mexico, workforce training subsidies and payroll tax incentive from automotive investments in the Bajío, Guanajuato, Querétaro, Aguascalientes. We have a buoyant automotive industry over there. And in Querétaro is a hub for aerospace industry. So there are incentives for this industry and the manufacturing sector. We have it is the plan to establish semiconductors facilities in Querétaro. So it is important to have them in mind. And finally, the next slide, please. We have some incentives Well, these are the incentives that I've just outlined. And the next slide, please. And we have some capital investment incentives in the federal level, and those are designed to stimulate investment that may include the immediate deduction or accelerated depreciation for certain capital expenditures. Deductions for training programs related for workforce development, and incentives for research, development, and technological innovation. And these incentives are specifically targeted to companies that establish in the development poles, these special regions within all across Mexican territory, where the Mexican government has considered that it is key to provide or to give some incentives for companies to establish there in certain activities and industrial sectors. So these measures may improve an after-tax investment return that is key during the early project phases. So this is, like I mentioned, a very high level overview of Mexican tax environments that any company that is thinking in establishing in Mexican territory and exploring the Mexican market has to bear in mind. And as you may see, the legal aspects and the tax consideration are go hand by hand. The one determines the other, and vice versa. So this is the tax consideration part, and I don't know if there are any questions, or Rodolfo, you want to add something to what we have said here.
Oh, thank you so much, Pablo. It's a great explanation. It's a, amazing opportunity for our clients and also for our, you know, potential clients that they are interested to invest in Mexico, all the tax implications and all the legal implications for doing that, right? So uh, it's super clear. Obviously, it's a lot of information for 1 hour. So I
Yeah, yeah,
I
yeah, yeah,
invite
yeah.
I invite my clients and my potential clients to talk to Anderson, to Ramon, and to Pablo. They are experts on their fields. They are super good attorneys, and they have a lot of experience in the cross-border transactions. So uh, I think, Ramon and Pablo, I would like to have more webinars like this one. I think it's a lot of information over there. We have, we have seen a lot of situations that where the client is never, as you said at the beginning, create a business plan to understand, and sometimes it's late, right? And we have penalties, and we have some problems with clients that they want to put everything as they has to be on the beginning. So uh, I just want to thank you, Pablo, and thank you, Ramon, again for being here. Thank you, Anderson, for the time, and I would like to have a more webinars like this one. I think it's gonna be potential for good for a lot of our cross-border clients. Uh, so I think the questions that are over here in the chat is already being answered. And I don't know if you want to add something, Ramon, or you, Pablo, but thank you so much for your time, and thank you so much for your experience and talking in this webinar. We appreciate a lot.
Thank you, Rodolfo, for the opportunity of talking to your broad audience.
Yeah, thank you, Rodolfo.
No problem. Okay, guys. Well, thank you so much for connected this webinar. For the people that was not online for X or Y reason, we're gonna send it to them. We're gonna share with our potential clients, and hopefully, we're gonna have the opportunity to honor the invites like Pablo and Ramon again in another webinar that we are thinking to to talk and understand how we can help clients to establish in Mexico in the right way. So thank you so much, Pablo, again. Thank you, Ramon. Thank you, Moni. Thanks, everybody, for the time. And we're going to see you pretty soon.
Thank you. See you.
Of course. Thank you. Bye.
Bye-bye.